Stock splits always seem to create a certain buzz. And we have two companies that announced stock splits in the upcoming months, Netflix and ServiceNow. We're going to talk about why a company does a stock split and the real reason that you should be excited.
Listen to Casey. The real reason you should be excited.
We're going to expand on this chart a little bit more. Shares outstanding for both ServiceNow and Netflix. This chart is brought to you by our friends over at fiscal.ai.
During earnings season, when a company updates its quarterly financials, one of the key things you should be looking for as an investor isn't the story around the business, but more simply how your equity in the business is being affected by any of those actual things happening when some investors talk about the story itself. And one of the key bits of information you need is shares outstanding, and you're going to want to measure changes in shares outstanding over time. Fiscal.ai is a great tool for doing these types of things during earnings season. We use it every day when a company reports earnings.
You can get 15% off any paid plan at fiscal.ai/CSI. They also have a new pro plan for you pros or aspiring pros out there. Check it out, 15% off fiscal.ai/CSI.
So Casey, we did some updates on ServiceNow after Q3 2025 earnings this week over on Semi Insider. And one of the things that was announced in that press release was a 5-for-1 stock split. Not bad, considering ServiceNow stock is still, even after some turbulence this year, well over $900 a share. Casey, tell the folks what ServiceNow does and why they're doing a stock split now.
Let's take a look at one of our company pages on our new research platform over at chipstockinvestor.com. ServiceNow is a workflow automation software company. ServiceNow has added a ton of tools with the advent of artificial intelligence or AI that automates tasks for all types of business teams. ServiceNow is a big software platform. They have a lot of different competitors in software as a service, especially in their CRM or customer relationship management. One of the main competitors would be Salesforce.
And if you follow ServiceNow, you probably know that for a number of years now, they have this interesting relationship with Nvidia, at least interesting relationship for an enterprise SaaS company, where Nvidia is actually described by ServiceNow as both a supplier and also a customer. So ServiceNow operates a multi-cloud platform. They also have some of their own cloud infrastructure installed in data centers. So of course they're going to have NVIDIA GPUs. But then the result of ServiceNow's software development gets used by NVIDIA. And in turn, NVIDIA uses ServiceNow to streamline their processes, develop new chips, which they in turn sell back to ServiceNow. And so then you get that virtuous cycle of improvement between the two companies. So that's kind of neat. And the result has been ServiceNow has been growing pretty steadily at or just above 20% in their software subscription for a while now. So that's great to see a company at this scale, of this size, $12 billion in annual revenue. And now, stock split. That surely means the stock price is going to go up. It always goes up after a stock split, right? This is why you buy companies that split their stock.
Well, we should probably add some more nuance to this discussion. Let's talk about why ServiceNow is doing a stock split. ServiceNow has had a pretty awesome revenue growth story over the past couple years, and they see that continuing through 2026 with new product launches, including their customer relationship management tools and AI automated workflows. With those record revenues comes employee stock awards and incentives.
Okay, we'll stop right there. Actually, in practical terms, this is oftentimes why a company splits its stock. When your stock price is somewhere in the ballpark of $1,000 per share, it may get tricky trying to award employees with stock awards. Maybe the employee hasn't earned $1,000 worth of stock. So do you issue partial shares or options on partial shares? Well, it might be easier if you just had a smaller stock price. So post-split, ServiceNow will be less than $200 a share. With a stock price a fifth of the size, an employee stock-based compensation program is going to be much easier to manage.
Now, you may be worried that ServiceNow is issuing too much in stock-based compensation, but management has been offsetting that dilution by repurchasing over the last few years. And so we continue to expect that stock repurchases will reduce the share count over the coming years. And if you're wondering when this is going to happen, it's going to happen in December 2025. Let's talk about Netflix now. Netflix announced a 10-for-1 stock split to be completed in November.
Netflix already posted Q3 earnings. They waited a few days before announcing this. It'll be complete after market close on Friday, the 14th. Similar story going on over at Netflix. New record revenues this year being driven by continuous global expansion, introduction of those new ad-supported subscription tiers, Netflix building out its own ad server and rolling that out to new countries. So I think we can probably safely assume at this point, probably record revenues will continue for Netflix into 2026 as well. At least that's our estimate, that they will continue to grow somewhere at a mid-teens percentage revenue growth rate or higher. And just like any good tech company, one of the ways you keep employees engaged is you give them equity in the business. So stock awards and incentives, Netflix stock over $1,000 a share, 10-for-1 split is going to reduce that down to just over $100 a share, assuming the stock price doesn't change between now and the 14th. Probably helps Netflix manage that employee SBC program.
So what does this actually mean for you as an investor who has some shares in either of these companies, ServiceNow or Netflix? I think we have a food illustration.
Of course, we have a food illustration. You would think that where before you had one share of a company, having 5 now in the case of ServiceNow or 10 in the case of Netflix would be much better. But think of it kind of like having a slice of pizza and the slice that you get is too big, so you cut it up. You still have the same amount of pizza, but now it's just in smaller bite sizes. There's no real actual added value to you, the investor. However, because as Casey mentioned at the outset of this video, a lot of buzz gets created when there's a stock split, and historically, stocks tend to do well immediately following a stock split. It almost becomes like self-fulfilling prophecy. Yeah, maybe the stock price goes up right after the stock split, but at the end of the day, you have the same amount of equity in the company itself. What will end up happening after these stock splits are finished is the total shares outstanding of the company will also get adjusted. So for ServiceNow, there'll be a 5x increase in the total shares outstanding. For Netflix, a 10x increase, and your number of shares that you personally own will also increase accordingly. So your actual equity stake in the business, all things being equal, doesn't change after there's a stock split. Just like your slice of pizza getting cut up into smaller pieces doesn't change the amount of pizza you're actually getting. But Casey, this does beg the question, why is it that historically companies that split their stock prices tend to continue rising? Is there actually another reason for this other than just maybe this whole self-fulfilling prophecy thing, everybody piling in because they hear that there's going to be a stock split?
Well, there is a lot of psychology in this, but it's also that these companies are growing. Companies that continue to grow their revenue and profit margins often at some point split their stock.
It's that simple. Wow. Okay. We're putting ourselves out of a job here. Here's another chart illustrating this. This is ServiceNow and Netflix free cash flow per share. And because it's a per share measurement, you're actually going to get the effects of, in the case of ServiceNow, a little bit of ongoing shareholder dilution because they're not quite offsetting all of their stock-based comp with repurchases, although they're getting close. It includes the effects from that in this calculation. And then for Netflix, their share count has actually been getting reduced for the last few years now from their stock repurchase program. So Netflix's free cash flow per share growth also includes a falling total shares outstanding count. This is where you really want to focus. If you're a long-term investor looking for businesses that you want to own for the ultra long term, this is the kind of stuff you want to look at during quarterly earnings season to see if your per share profit is rising or falling. What's the long-term trend? And as Casey said, if the trend is higher, stock prices tend to rise. And as a result, when stock prices get high enough, companies tend to split the stock eventually.
Thanks everybody for watching this episode of Chip Stock Investor. You all got a sneak peek at our new Semiconductor Insider Research platform. You can get access to that via our Semiconductor Insider membership exclusively on our website, chipstockinvestor.com. Check it out. We'll see you over there. This actually makes me think of another food illustration. When you go to the break room at work and there's like a box of donuts and you don't want to eat a whole donut, so you just cut the donut piece by piece until you finish the entire donut. Is it something like that?
Who does that?
Everyone does that. Maybe you don't do that, but everybody else does that.
Just going for the whole donut, I guess.